Over the past year, Wells Fargo stock is up 62%. That is right. Over the past year, it has outperformed basically every stock outside of the super high flying ones like a Tesla, a Palantir, or an Nvidia. Wells Fargo, a major money center bank, currently with a PE of just 13 times forward, trading up 62% over the last year. What the heck did this company do over the past year to drive that type of performance? Also, are there some things that we can learn from Wells Fargo? Because some of you might even remember this bank. It was embattled in all those types of controversies. They were setting up accounts and they've gotten slapped down by the regulators. In fact, they still have an asset cap, meaning they can't take in over and above a certain threshold of assets. And eventually that will be lifted. But the company has done some miracles over the past couple of years, including new management. We'll talk about, is there some things you can learn there? When companies get new management and they do a great job, you could potentially have dramatic outperformance like you've seen over at Wells Fargo. We'll look at all of this in context that they came out with Q4 numbers. We also got some guidance, not full guidance and everything, but we got some expectations, I think is the best way to say it, from Wells Fargo for the upcoming year. We'll go through some of the consumer and business side of Wells Fargo. This is a great window. You've got to follow the banks, whether you invest in them or not. If you did great this year. Even if you don't, you've got to pay attention to what's going on here, because if the banks start collapsing, then the rest of your portfolio is. And if the banks are holding up relatively well, probably means we're in for at least a decent year. Look at the consumer side, the business side, the commercial side. We'll look at the corporate side. We'll also look at wealth management. When we looked at JP Morgan earlier, actually both of these companies called this out on the conference call, saying that wealth management could be an area of growth there. We'll talk about that, and we'll go over some of the conference call highlights as it relates to Wells Fargo, but otherwise as well. And we'll look at this technically. There are areas where if you do get pullbacks, shares were up nearly 7% today. But if you do get pullbacks in Wells Fargo, there are, I think, obvious areas. What is going on, investors? Hopefully, guys are doing well out there. Time to take a look at Wells Fargo. Q4 numbers came out, $20 billion. And what's interesting is the stock is reacting very nicely, not over the past year, but during the aftermath of these results. But when you go through things here, you'll see it's not that great. Honestly, revenue declined by about 0.5% year over year. It also missed expectations by about $200 million. Speaking of those expectations, the upcoming year, you're expecting a relatively muted growth, seeing this across the financial industry after that breakneck pace of interest rate rise. In fact, a historic, I think, interest rate hikes conducted by the Federal Reserve of the past, I guess it's been maybe 12 to 24 months or so. Well, they raked in a ton of interest income. You've seen a little bit normalization there as obviously consumers pull back on their demand for home loans, auto loans. We'll see that here in a moment. And the bank obviously has to pay out usually a little bit more on interest as well. In terms of the conference call, read through the conference call over at Wells Fargo. It was a good one. And I tell you what, Wells Fargo is a really good example of a company with some solid foundation. Now, we know a couple of years ago, they were setting up accounts and they were doing all this basically illegal stuff as it relates to stuff involving their customers and compensation and promoting their own products within the company. Well, it was still a solid company with a solid foundation, but it was plagued by poor management and really more or less greed. And it found a solid leader, and look how he has gotten things back on track over at Wells Fargo. In fact, I did a video on this. I don't know if you guys all saw this. It was about a week ago when I was in Vegas. I recorded this video. I had an off day there, and I have found 4 stocks that I think are actually in the exact same situation as Wells Fargo. You've got solid foundations at all 4 of these companies. They've all had their problems from one thing to another, and they all 4 have new leaders. Actually, one doesn't, but I think they'll get a new leader here. But I think out of the 3 of the 4 that have picked new leaders, they've picked fantastic. We are talking top of the line leadership there. And I think all 4 of these stocks could have great years in the coming years ahead. I'll put a link down in the description, probably first pinned comment as well to this video. You want to check it out if you haven't seen it, because I think some of these stocks could start performing like Wells Fargo. Now, Company is projecting modest loan growth in 2025. But what was interesting on the conference call is they talked about how they're going to be reliant on that kind of coming in the second half of the year. They talked about the new Trump administration. There's certainly some bullish sentiment from businesses, maybe an increase of M&A activity. Consumers were seeing it as well. Talked about how last week we saw Delta Airlines, their CEO got on right after the elections. People were booking travel out all through 2025. So the consumer and businesses are bullish on Trump. We'll see if that materializes. It's certainly possible. But I see a lot of companies banking next year on the back half. And what that means is they're not confident. The demand isn't here today over and above expectations. What they are hoping is it shows up in the back half. And look, if it shows up, it's probably good for stocks. If it doesn't show up, well, these stocks are probably at the very least fully valued, if not have a sideways year. Reduced headcount. This company has been slashing jobs. We've seen that across Wall Street. That has driven some of the performance we've seen in stocks, certainly in the tech sector as well. Yes, they've had revenue growth, but what they've done is they've cut costs. That has increased cash flows. It also has increased EPS. Most of these stocks are also buying back the shares. So the combination of headcount reduction and buying back the stock is, I wouldn't say artificially increasing EPS, but it is a contributing factor. Can these companies continue that? Is it sustainable to reduce your headcount, at least in your mortgage division over at Wells Fargo, by 47%? Probably not going to have another 47% reduction. Same thing across the board at Wells Fargo. Same thing at the tech companies. So they're going to have to put up higher revenues with the lower staff. We'll see. You just can't cut your way to profits forever. And I think 2025 will be the year that more or less ends. And then finally, since 2019, Wells Fargo has reduced the number of shares outstanding by 21%, certainly contributing to some of the growth you've seen through buybacks, which again are more or less capped over at this company. This company, all banks have some financial constraints, and Wells Fargo has more than others based on the scandals that occurred several years ago. But they also increased their dividend by 15%. I think some of the action that we're seeing in Wells Fargo is a front running of the restrictions fully getting lifted off. Company is able to resume even more buybacks and a larger dividend increase. But the company's certainly doing a nice job. Management over at this company deserves a lot of credit. Now, they gave us an outlook for 2025. Net interest income, which is more or less kind of operating profit for banks, expected to increase about 1 to 3% higher in 2024. I think that was enough for Wall Street to look at. Wall Street was expecting, at least on the revenue side, just 1.7% growth. And then actually on the earnings side, they were projecting negative growth on the EPS side. So Wells Fargo certainly more bullish on that. They also had non-interest expense not coming in nearly as hot as I think is expected. In fact, they might be shaving a couple of points off this. They're doing a very nice job over at Wells Fargo. Obviously, they're eliminating some staff in some divisions, like the mortgage division, which certainly remains under pressure. I'll show that to you here in a minute. But they're just streamlining things all together. Overall, the company gave very, very good guidance. And then when we go through the numbers, they're not that great. Retail loan originations, yes, they are ticking up, but I'll show you here. From an earnings perspective, they were actually just up fractionally. You also saw more refinancing activity, which you'd have to expect will probably tail off into the first quarter. Although as you move into the back half of next year, if the drop in interest rates actually carries over to the mortgage rate, we're not seeing it right now, but if you can get mortgage rates, I think meaningfully below probably 6, maybe even 5 would be a dream. Anything back into the 3s and 4s, you are going to see a mass acceleration into refinance. There's a ton of people that would love to refinance. In fact, you saw a very steady increase of that over the past several quarters. That will likely taper off. Also, auto loan originations ticked up very nicely, but again, when you dive into the details, you actually see a decline of earnings by 21%, at least on the consumer side, in terms of auto loans. So yes, you are seeing an uptick a little bit in activity, but it's not flowing through to earnings because, again, the spread on the interest rates is a little tighter this time around. Company talked up their credit card business and the fact that they've really put a lot of money and a lot of effort behind launching new card products and new promotions. And it is driving down profitability somewhat on the credit card side. And that company, or Wells Fargo, is saying that they'll be able to drive higher profits for credit cards, again, as those, sign up teaser bonuses, no interest rates for 12 months, 16 months, whatever they offer you. They're essentially losing money on you as a customer for a year in order to retain your business and make money on you in the future. Maybe you come and then take out an auto loan or open up a checking account, those types of things, and maybe other fees apply. From the consumer side, earnings dropped 7% year over year from 6.5 down to about $6 billion. I think from a very high level, when I look at the different business units, two things that I look for when I'm looking at a bank. First thing I'm looking is provision for credit losses. Those actually went up relatively nicely, and that's not a good thing. Up 15% from 790 to 911. Again, that's on relatively similar type of earnings. Also, loans year over year were actually down 4%. So they're lending out less and at the same time setting more aside for provision for credit losses. It's not a trend that we're concerned about right now because these are still relatively low numbers compared to certainly pre-pandemic. But if the trend continues where you continue to set aside provision for credit losses while loans continue to drop, well, that does make us nervous as investors and probably in the overall economy. Deposits also declined 1%. That is what is also not that big of a concern. People still have jobs while they're not able to increase the amount on deposit. It certainly isn't draining out as well. Both banks, JP Morgan, Wells Fargo, I'm certainly every single one that we look at, you're not seeing as much yield-seeking behavior by depositors. So a year ago when interest rates were ticking up, people were pulling their money out of the low interest checking account or savings account that you might have at Wells Fargo. You might go put it in a money market account. You might put it in a CD. You might even pull it out of the bank and go put it somewhere else in a SoFi or one of these high yield checking accounts. You're not seeing that as much. And that certainly benefits companies like Wells Fargo as they get cheap deposits. On the commercial banking side, very similar story, at least on the loan growth side. Lower loan growth year over year, we'll just call that flat. But what's interesting is you're seeing at the business side, bigger deposits up 13% year over year. That could spur some M&A activity as we move into this year with the new Trump administration. Again, this is the narrative. Whether or not it plays out remains to be seen. But the narrative is less regulation, less fighting from the FTC, more business combinations. And when businesses have 13% more deposits, you have to assume one thing that they could do with those deposits over the next year, while they might not have employees that they can lay off and cut costs like they used to, well, maybe you go out and get your growth through M&A. And that's very exciting for these companies from that perspective. Corporate investment banking looking relatively nice, although again, across the board on the loan side, you're seeing declines by about 6%, but deposits climb. So this is good, again, from that M&A narrative when the corporates and the businesses have cash and there might be a willingness, or in some cases, some people might even say the eye being turned in Washington from a regulatory perspective. Well, you might see more investment there. And finally, on the wealth management side, we also heard from Wells Fargo, they believe this is an opportunity for them. These banks, including JP Morgan, they have, some of their consumers have credit cards and checking accounts, and they might do kind of traditional banking with them, but they take their wealth management business over to a Goldman Sachs or to a Schwab or to a BlackRock or one of these other companies out there that are a little more specialized in this. Both of the companies called that out. You did see total assets grow by about 10%, but again, some of that has to do with equity markets doing quite well. Amount of deposits up meaningfully as well. The high-end affluent consumer is doing just fine. We saw that with Delta Airlines. They're flying premium. They're flying to Europe. The baby boomers are loving life. Okay, they own their house. They have tons of equity. They don't give a crap about anything. They earned it, and it's awesome for them. The businesses are actually doing relatively well. The ones that are making money, the ones that make cost cuts are doing well. The consumer, I think, is just scraping by. Certainly the mid to low end consumer is just scraping by. They need to hold on to their job. If they were to lose their job, certainly in any meaningfully number over the next 12 months, we certainly hope that doesn't happen. But if they lose their job, boy, this economy could take a turn for the worse because there are some underlying, I wouldn't say cracks, but there's some crevices here that don't look that great. Now, what does look great is Wells Fargo. After making some lows down here at 2020, I mean, we have been on a massive run here. Higher highs, higher lows. It looks absolutely fantastic. That was after several years, basically a decade and a half of going sideways between 27 and 58. Once you break above those highs, saw this with Netflix, seen it with Tesla recently, break above these highs, I think Palantir as well, chart looks similar to this. Break above the highs, you can have this kind of blow off. When you have the blow off, you can play the momentum here if you want to. Most investors, though, you're kind of like me, you wait for pullbacks. A back test around the previous highs, back to 63 on Wells Fargo. That would be the first area where I'd be interested on this one. Fundamentally, things look good. The conference call was great. They've got great executives. I actually think that I have 3 or 4 other stocks that are in a similar position as Wells Fargo. Probably rather put new money in there. The technicals on these stocks actually looks better. These are actually all 4 a buy. In fact, I've recently bought all 4, added to all 4 positions. And I think they could have years like Wells Fargo did over the past year, up 62%. And then even put up kind of a stinker quarter in the fourth quarter from a revenue perspective, missing expectations. But things were so bad that they're actually good again. And you still have a relatively low valuation. We didn't look at tangible book, but it's not wildly crazy with Wells Fargo. This one's been hitting it out of the park, and it's a great example that if you're not looking into these other areas of the market, you would have missed outperformance, as was the case with Wells Fargo. But again, I'm doing my best to try to find other areas where over the next 12 months, you could have that outperformance. Again, hate to keep shilling the video, but it is free. You don't have to pay for it. And it would only take maybe 11 minutes of your time to get 4 stock ideas. Hopefully you enjoyed today's video. Be back again with more. I'll see you again later. Good luck with your investments.